Ever wonder what makes the financial world tick? Do you find yourself puzzled by concepts like compound interest, inflation, or risk diversification? Well, stick around. This video is like a decoder ring for the financial cipher. First, let's demystify compound interest. Think of compound interest as a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, growing bigger and faster. In finance, the snow is your interest. You earn interest on the money you've deposited or invested, and over time, you begin to earn interest on the interest. That's the snowball effect. The longer the time, the larger the snowball becomes. Now imagine you have $100 and you put it in a savings account with a 2% annual interest rate. By the end of the first year, you've earned $2 in interest, so now you have $102. Then, in the second year, you earn interest not just on your original $100, but also on the $2 of interest from the first year. This might seem like small change, but over the years, this can add up to a substantial sum. Next, let's tackle inflation. Inflation is the rate at which the general level of prices for goods and services is rising. As inflation increases, every dollar you have buys a smaller percentage of a good or service. For example, if the inflation rate is 2% per year, a pack of gum that costs $1 today will cost $1.02 next year. Inflation is like an invisible tax that erodes the purchasing power of money. That's why it's so important to invest money in a way that outpaces inflation. Otherwise, the value of your money declines over time, even if the number of dollars you have stays the same. Lastly, let's unravel risk diversification. Risk diversification is the financial equivalent of not putting all your eggs in one basket. It involves spreading investments across various financial instruments, industries, and other categories to reduce exposure to any one investment. Imagine if you invest all your money in the stock of one company. If that company goes under, you lose everything. But if you spread your investments across 20 different companies in various industries, the poor performance of one company won't affect your entire portfolio. So, in summary, compound interest is the snowball that, given time, can turn a small sum into a fortune. Inflation is the invisible force that erodes the value of money over time. And risk diversification is the strategy of spreading investments to mitigate losses. Understanding these concepts can provide valuable insights into how to grow and protect your wealth. So, the next time you're making financial decisions, think about the snowball, the invisible tax, and the basket of eggs. These simple metaphors can help demystify the complex world of finance. It's a financial world out there, and with these insights, you're well equipped to navigate it.